Hey everyone, welcome back to the channel. In this video, I'm going to be doing a breakdown of Spotify stock and doing a basic intrinsic value analysis using a discounted cash flow model. Spotify's been in the news quite a bit recently for probably all of the wrong reasons, but hey, we're going to do an analysis anyway, see what potential growth the company might have for the future and see what the stock might be worth. But before I get into that, as with all of my videos, especially as they have to do with individual stocks, be sure to do your own research before you invest into any of them. I'm making my own assumptions here. You might make very different assumptions and your risk tolerance might be quite different as well. So be sure to do your own due diligence and hire a licensed financial professional if you need any more help. I am not one of those. I'm just some guy on YouTube. Anyways, here is Spotify stock, which is down quite a bit over the last 52 weeks. We're down about 47% over the last year. And by the time this releases, we'll see if it's any different because we're in a very volatile stock market right now. But as of the beginning of the year, so year to date, we're looking at about a 30% drop off from the very beginning of the year. So the stock price is definitely going through some pretty rocky times. This puts Spotify's market cap at $33 billion. So still a large company based on those terms. And just in case you have no idea what Spotify is, here's a nice little overview for you. Spotify, together with its subsidiaries, provides audio streaming services worldwide. So specifically with music, podcasts, it's a streaming service. It operates in two segments, premium and ad-supported. Premium segment offers unlimited online and offline streaming access to its catalog of music and podcasts without commercial breaks to its subscribers, while the ad-supported segment, well, it has ads. And here's their current subscription page if you want to sign up for the premium version without ads. That is currently for an individual at $10 per month, and you can get a family account for $16 a month. You don't have to pay for this to use Spotify. They also have a free version with ads. Let's go ahead and take a look under the hood and see what's going on with Spotify financially. So we'll go to the financials, and I like to take a look at the balance sheet first to see what they're working with. Right now, they have about $2.7 billion in cash, and when you add on some short-term investments, they're looking at about $3.4 billion in cash and short-term investments. And we can scroll down and see how this compares to their debt. So right here under the liability section, they have long-term debt of $1.2 billion. And if we add all of their liabilities, including current liabilities, we're looking at about $5 billion. But I'll really just focus on the long-term debt here. They have some leases to worry about. So maybe $1.7 to $1.8 billion is what I'll use for the long-term debt number. And we compare that to their cash. And they could take their cash balance and pay off all of their long-term debt if they wanted to in one fell swoop. Now I just switched this to a quarterly view, and I want to look at one more thing on the balance sheet, and that is total shares outstanding, because I want to see if Spotify is diluting their shareholders by issuing new shares, which it looks like they have been to a pretty significant degree. This is just over the last 2 years. They've added about 5% to their total share count. So some pretty significant dilution, all things considered. And what I mean by dilution is this: when you have a company, you have all of its profits, and when you're a shareholder, you're entitled to a share of those profits. That's the whole point that you invest in a stock, or at least you'd think that's the point. Well, what a company can do is if it wants to raise some money, it can actually sell additional shares of its company. So now there are more shares out there. And when there are more shares out there, you now have a smaller fraction of the business and all of its subsequent profits. So looking at it from that perspective, dilution is bad for shareholders. And I suppose you could make an argument that it's not so bad if the company can reinvest the cash that it raises from issuing shares, and it reinvests it in a really good way to where it's totally worth it in the short term to take some dilution if the company really can propel itself that way. But if a company's really that good at allocating capital, they could also take out debt. It's not as though they have to dilute shareholders to do that, but it's just one factor of many. And with Spotify's case, they are still in growth mode, so it's not that surprising to see some pretty significant dilution, although it's not too crazy, but it's still something to keep an eye on. So that's it for the balance sheet. Let's go ahead and switch this back to an annual view, and now I'm going to look at the top line revenues. So we'll go to the income statement, take a look at revenue, and we can see it's been growing pretty rapidly. We're up to almost $10 billion in annual revenue as of 2021, since we just had the fourth quarter earnings released and the stock tanked on those earnings. We'll get back to that in just a second. But if we scroll down a bit, we can see the growth rate in revenue currently is, it seems like they've been hovering around that 20% mark, at least over the last couple of years. You had 17% or so in 2020, 23% in 2021. It's hard to say exactly what the future will hold, but they have had some pretty big revenue growth numbers in the past, up over 50% in 2016, nearly 40% in 2017. But that growth trend seems to be going down, at least on a rate basis. Revenues are still growing pretty significantly, but the rate of change in percentage terms is starting to slow down if we look at a longer term view. One thing I will note is that even though these revenues are growing, you're actually seeing growth in gross margins as well. So it seems like they could be getting more and more profitable as they achieve more scale. We'll see how high these margins really can get, but the trend is positive from a margin perspective. Hey guys, real quick, be sure to check out the affiliate links in the description below, especially the ones to Webull and Robinhood if you open up accounts with with those links, you get some free stocks. I get some free stocks as well, so it's a win-win. So you might as well do that now. It's free money.
It's free real estate.
Well, let's go ahead and switch over to the cash flow statement. I really want to know what that is as an investor, because anyone can grow top line revenues if they're also blowing out expenses or their capital expenditures are super high. In the meantime, you're not really seeing that return to you as a shareholder necessarily. So I want to see what the free cash flow number is. It's the lifeblood of any business long term. So we'll take the cash from operations minus capital expenditures, and that's how we reach free cash flow. And we can see in 2021, free cash flow was just under $300 million per year. Remember, we're talking about a company that's priced, at least in market cap terms, at over $30 billion, and they only brought in $300 million in cash flow per year. But of course, this is a growth stock, and we would expect these cash flows to grow to some level. The question is how much. And again, we'll get to that when we do our discounted cash flow. But as of now, we're not really seeing explosive cash flow growth despite the pretty substantial growth in revenues, at least over the past few years. We actually had higher free cash flow back in 2019, and then it was over $400 million per year. So free cash flow has come down, even though capital expenditures have also come down. So you don't like to see that if you're really looking for this big positive trend in free cash flow growth. It's not to say that they can't turn that around in the future, but it is cause for concern. So it is nice to see that they are actually cash flow positive, which a lot of so-called growth stocks are not. But now the question becomes, how much can Spotify reasonably expect to grow in the future? As I mentioned earlier, Spotify recently had their Q4 2021 earnings call, and things did not go all that great after the earnings call, at least for the stock price. It tanked pretty hard. Spotify is projecting continued user growth, but I guess investors were not too thrilled with the projections that they were laying out there. They weren't super stellar, at least based on what people wanted, I guess. And speaking of their user growth, let's take a look at the trend over the past few years. And we can see that the number of Spotify monthly active users has continued to grow quite steadily, and they're up over 400 million active users according to their most recent earnings call, which isn't actually reflected on this chart. Keep in mind, this is all of their monthly active users, not just those who sign up for the premium service, but regardless, it's a very big number. And as of Q4 2020, we're looking at something like 180 million premium subscribers based on their most recent earnings call. So still a large number that's continuing to grow for the premium subscriber side. But how does this compare to some competitors? And here's one of their biggest competitors, Apple Music, which currently sits at around 80 million subscribers. So still very much behind what Spotify is currently at from a user count basis, though they continue to grow as well. And here's a quick breakdown showing the share of music streaming subscribers as of the early part of 2021. So this isn't totally up to date, but it gives you a pretty good idea. Spotify is by far ahead of all of the competition. Spotify currently has around a third of all of the active music subscribers in the world, with Apple in second place at about 16%, followed by Amazon and Tencent Music at 13% each, and then a bunch of others. Oh, look at Pandora making it in, how cute. So if we assume that Spotify doesn't actually take any additional market share from its competitors, the question would be, how much is the pie going to grow? Sure, they might have a third of the pie, but if the pie keeps growing, then they would keep growing as well. I found this study that suggests that the estimated growth of the global online music streaming market would be something like 10% over the next few years, and maybe that's true. I'm not really sure how accurate this could be because, well, neither can they. This is trying to tell the future, and who knows what the future actually holds, but I guess we can use 10% as a sort of benchmark. But I believe this is just for music. It doesn't really include podcasts, which is a big part of Spotify's business model. And to that, they've been dealing with quite a bit of bad news, especially as it relates to Joe Rogan and some not so great language he's used in the past. And there's been a lot of backlash against his podcast and what he's done with it. I'm not trying to get into the details of that in this video, but realize there is some controversy here, and we'll see how Spotify gets through this. Joe Rogan does have the biggest podcast in the world, so it's going to be pretty important for a platform like Spotify that relies a lot on podcasts and music. And I found this study suggesting that the global podcasting market will grow something like 30% per year over the next few years. Again, we'll see if that actually comes true, but it seems like podcasting is continuing to grow faster, even faster than music streaming. So now we have the tricky question of valuation, and this is a discounted cash flow model, so we'll see what numbers we can plug in here for Spotify and see what result we might get. So we have a starting cash flow of around $300 million per year. This is in billions, so I did 0.3, $300 million. We have their excess capital right here, which is their cash and short-term investments minus their long-term debt, which I just rounded to $2 billion. I'm using a terminal multiple of 15, which would multiply the year 10 cash flow in this case, because this is a 10-year analysis. It would multiply that number by 15, and that would get you the terminal value of the business on that free cash flow basis. I'm using a discount rate of 15%, which means that if all of my assumptions come true and I buy the thing at the intrinsic value based on these assumptions, I'd be expecting around a 15% return per year. Now, as for growth rates, this is where it's extremely tricky. This is the growth in free cash flows for Spotify, and it's very hard to say what the future is going to hold for them. Not only because it's hard to say what the revenue growth is actually going to be, how much are their margins going to expand, and then what's competition going to look like in the future. One thing I didn't mention with Spotify is the fact that for their music streaming, they don't own all of that music. Instead, they get a license to use that music from the people who do actually own that music. Think of companies like Universal Music Group. They will give Spotify the rights to play their music and charge a fee for it, and then there's probably some revenue sharing agreement where they give money to Universal Music Group or pay some sort of fee. So Spotify starts making more and more money using the music from other companies. Those companies might say, hey Spotify, we see you're making all that money. Let's go ahead and bump up those fees a little bit because after all, you can afford it and you're making so much money with our products, so please pay us a little bit more. That would hurt Spotify's underlying margins. I'm not saying that will actually happen, but it is a sort of risk. The point is, at least on the music side, they're at least partially at the mercy of the people who actually own and create the music. So I went ahead and used a growth rate of 30% for the first 5 years, followed by 15% free cash flow growth for the next 5 years. I'm not saying this will happen. This is pretty aggressive growth when you really look at it. We're getting up to $2.2 billion at the end of year 10. And this is really the number that I'm trying to pay attention to. Can Spotify basically 10x their cash flow, going from $200 or $300 million up to 2.2 or almost $2.3 billion at the end of year 10? Sure, maybe they could do that. I'm not sure how likely it is. They would definitely need to expand margins. They'd need to expand revenues, and they could do both of those things, but it might fall quite a bit short of that. I'm getting ahead of myself a little bit, so let's go ahead and do the discounted cash flow analysis. We take the year zero cash flow, multiply it by the growth rate, and then we keep growing those cash flows based on the growth rates that we've assigned. We then discount those cash flows appropriately, and we also discount the terminal value here, which takes the year 10 cash flow times that 15 multiple we're using, but we do discount that as well. We then add up all of column G to get the present value future cash flows of around $13.3 billion, which means that the intrinsic value, once you add on their excess cash, is at $15.28 billion if all of these assumptions were true. But with a current market cap of around $33 billion, that would mean that you have a margin of danger of 54%. Again, assuming these assumptions, which you might not think are true, you might think they're super aggressive, or you might think they are unreasonably conservative. It's up for you to decide. Because if we jack up the growth rate in the first 5 years to 50%, then it's looking like a better deal. That would give you an intrinsic value of more like $28 billion, but that's some pretty lofty growth. We're getting up to almost $4.6 billion by the end of year 10 in free cash flow. And Spotify, at least in recent years, has not seen this sort of growth. In fact, revenue growth is slowing even as margins expand, and we're not seeing explosive cash flow growth. At least we haven't seen it in the last few years. It's not to say that they can't turn the corner, maybe by raising the subscription fees, adding more advertisements, making their ads better and thus more expensive. The point is, a lot of things need to happen for this model to make sense. And the loftier the growth assumptions become, the more that needs to happen. Maybe Spotify gets to this in the future. I'm not really sure, but it's not something that I'm looking to invest in, at least at these prices. If I go ahead and assume a 15% growth rate over the next 10 years, then it's looking like I'd want to wait till Spotify's under $10 billion. This might be where I'd get a lot more interested in it based on at least current cash flow numbers. Maybe they really do turn the corner in the coming years, and then I might be more interested at a more expensive price. I'm just not really sure what a reasonable cash flow projection is for Spotify even just a few years from now. So although I'm not planning on investing in it, it'll be interesting to see what happens with Spotify, especially in the near future as they go through some of this controversy. Maybe this will end up being some sort of turning point for the company, for better or for worse. We'll see what happens. Either way, I'd definitely love to get your thoughts on Spotify and its business in the comments below. With that said, if you like this video, definitely like it since that would help the channel out a lot. And if you want to see more content as it has to do with investing and personal finance, be sure to subscribe since I put out new videos every single week. And check out the free stuff in the affiliate links in the description below. But until next time, take care.